Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into a pressing issue that's been making headlines: housing unaffordability still on the rise despite billions in government measures. This topic comes to us from a recent analysis by the Parliamentary Budget Officer, as reported by the Canadian press. According to the report, the number of Canadians in need of affordable housing continues to climb, even with significant federal spending aimed at tackling this issue. The Parliamentary Budget Officer's analysis highlights that 2.4 million Canadian households are currently in what is termed as core housing need. This figure has increased by 662,000 since Canada launched its National Housing Strategy back in 2017. The National Housing Strategy, as you might be aware, aims to alleviate the core housing need for 580,000 households by 2028. However, the Parliamentary Budget Officer's projections suggest that the government is not on track to meet this goal. In fact, they're forecasting an additional 926,000 households will be in core housing need by 2028 compared to when the strategy was initiated. It's important to note that the concept of core housing need is a specific affordability measure. It refers to households living in homes that require major repairs, lack sufficient bedrooms, or where the total housing costs exceed 30% of the household's gross income. Additionally, the household must reside in a community where the median cost of housing is above 30% of their gross income to qualify as being in core housing need. The report does acknowledge that without the government's affordability measures, an additional 78,000 households would have been in core housing need by 2027. This suggests that while the measures may not be hitting their targets, they are still providing some level of relief. One of the key factors contributing to housing unaffordability for homeowners is the higher interest rates at the time of mortgage renewal. Despite the policy interest rate cuts in 2024 and expectations of further declines, the average interest rate for outstanding mortgages remains higher than it was in 2017. For renters, the rising costs are largely driven by increased demand, partly fueled by immigration and a persistent shortage of housing stock. The delay in housing starts has not kept pace with the growing demand. However, the Parliamentary Budget Officer mentions that Canada's revised immigration targets might help ease the pressure on rising rent prices. In terms of government spending, the report outlines that Canada plans to allocate an average of $6.1 billion annually over the 10-year term of the National Housing Strategy to address housing affordability. Adjusted for inflation, this represents a 50% increase in spending compared to the decade prior to the strategy's launch. This works out to approximately $168 per person each year. The Housing Minister, Sean Fraser, responded to the report by emphasizing that, after years of federal inaction, the government is now making historic investments to resolve the housing crisis. On the other hand, the Conservatives criticized the situation, labeling it as housing hell, and highlighted the unmet promises by Prime Minister Justin Trudeau to fix the core housing need for 530,000 households by 2027. This report underscores the complexity of the housing affordability challenge in Canada and the varying perspectives on how effective the current measures have been. As always, we'll continue to monitor these developments closely and bring you the latest insights. The Bank of Canada's recent decision to cut its key interest rate to 3.25% has been a significant move in an attempt to boost the struggling Canadian economy. However, despite this substantial reduction, experts are cautioning that fixed mortgage rates may not see the immediate drop that many homeowners might be hoping for. According to BMO senior economist Robert Kavcic, even with the central bank's second consecutive half-point cut in its policy rate, fixed mortgage rates in Canada may have already reached their lowest point. Unlike variable rate mortgages, which respond directly to changes in the Bank of Canada's policy rate, Fixed-rate mortgages are influenced indirectly through bond yields. Kavchich points out that while variable-rate debt holders, such as those with home equity lines of credit, will see immediate relief from the rate cut, those shopping for fixed-rate mortgages should not expect the same easing. This is because the 5-year Government of Canada bond yield, which is a key determinant of fixed mortgage rates, actually ticked higher following the rate cut announcement. As we look towards 2025, Kavchich warns that unless there is a drastic shift in expectations for the Bank of Canada's policy decisions, the potential for further decreases in 5-year yields, and thus fixed mortgage rates, might be limited. This suggests that the current low for fixed mortgage rates could persist if the economy remains stable. Victor Tran, a mortgage and real estate expert with Rates.ca, echoed these sentiments, describing both bond yields and fixed mortgage rates as pretty stubborn over the past several months. While there has been some fluctuation, rates have largely settled in the low to mid 4% range. Tran anticipates that as we move into next year, home buyers and those with upcoming mortgage renewals might see rates dip into the high 3% range. However, he also notes that lenders are currently proceeding with caution due to ongoing economic uncertainties, including potential trade tensions with the United States. Interestingly, the gap between fixed and variable mortgage rates is narrowing, which is complicating decisions for those considering locking in their rates. Tran mentions that many customers are now faced with the choice between the stability of fixed rates and the potential benefits of opting for a variable rate, hoping to come out ahead as the market evolves. Recent trends suggest that Ontario could see a significant increase in first-time homebuyers, potentially up to 30%, as we head into the new year. The Bank of Canada's recent decision to reduce the overnight interest rate to 3.5% is expected to play a crucial role in this potential uptick. This rate cut, alongside changes to insured mortgage rules that increase the national price cap to $1.5 million and extend amortization periods for first-time buyers to 30 years, is creating a more favorable environment for new entrants into the housing market. Richard Ramiz, who operates the Ontario-based real estate platform Zone, has been closely monitoring these market trends. He notes that there has been a noticeable increase in inquiries from prospective homebuyers compared to the previous year. Ramiz anticipates that over the next few months, there could be a 20 to 30% rise in first-time homebuyers in Ontario. Ramiz attributes this anticipated surge not only to the current buyer-friendly conditions, but also to a buildup of demand that has been simmering since the early days of the COVID-19 pandemic. Many potential buyers have been waiting for a drop in interest rates to make their move. Furthermore, Ontario has seen a significant influx of new arrivals over the last few years, many of whom are now ready to purchase homes after finalizing their permanent residency. According to data from the Toronto Regional Real Estate Board, 21% of newly arrived immigrants in 2024 prioritized purchasing a home. Ramiz predicts that many new buyers will act swiftly in January to avoid potential price increases later in the year. However, many sellers are expected to hold off listing their properties until spring, aiming to capitalize on possibly higher demand and prices. This cautious approach by sellers means that the upcoming months could represent a critical window of opportunity for buyers. However, Ramiz warns that if too many buyers enter the market simultaneously, it could disadvantage first-time buyers. Second-time buyers, who typically have more equity from selling their first homes, could outbid newcomers if the market becomes saturated. Ramiz advises first-time buyers to proceed with caution, emphasizing the importance of understanding their financial limits before entering the market. He suggests that there is no universally good or right time to buy a home, but rather a time that aligns with an individual's financial situation and readiness. Canadian real estate buyers may be feeling a bit let down following the recent supersized rate cut by the Bank of Canada. A new memo from BMO highlights that the overnight rate reduction primarily benefits those with variable rate mortgages and home equity lines of credit. Unfortunately, those who were hoping for more affordable fixed-rate mortgage options did not see the relief they anticipated. This is because these popular fixed-rate loans have already factored in future rate cuts. The Bank of Canada's overnight rate cut impacts variable loans, while government bond yields influence fixed-rate loans. In a competitive credit environment, loans with similar terms tend to move together. The slashing of the overnight rate is a boon for those with variable cost loans that rely on short-term borrowing costs, including home equity lines of credit and variable rate mortgages. Although these loans gained popularity during a period of low-rate enthusiasm, they still represent a smaller segment of the mortgage market. In contrast, fixed-term mortgage rates are driven by the yields on Government of Canada bonds of similar duration. These bonds carry a slight premium due to their slightly higher risk compared to government bonds. For instance, a 5-year fixed-term mortgage rate is closely tied to the 5-year Government of Canada bond yield, which is in turn influenced by the inflation outlook. A robust economy typically leads to increased consumption, boosting inflation, and consequently raising the 5-year bond yield and fixed mortgage rates. Conversely, a weaker economic outlook can help lower borrowing costs. What the recent rate cut did accomplish was to alleviate short-term interest costs without impacting medium or long-term expenses. Robert Kavcic, a senior economist at BMO, explains that those with existing variable rate mortgages or home equity lines of credit have experienced significant relief this fall thanks to the Bank of Canada. However, the fixed mortgage rates, particularly the 3- and 5-year fixed rates, had already accounted for these rate cuts. In fact, Canadian 5-year Government of Canada yields, which determine fixed mortgage rates, actually increased on the day of the rate cut announcement. The reduction in rates helped lower costs for home equity lines of credit and variable rate mortgages, providing some income relief and potentially boosting consumption. Yet, it did not offer additional incentives for new buyers. The more popular 5-year fixed-term mortgage rate was already relatively low and even saw a slight increase due to heightened inflation expectations driven by increased consumption. BMO points out that the fixed-term mortgage market has already priced in the next potential rate cut. Robert Kavcic mentions that even if the Bank of Canada continues to reduce rates, with another 50 basis points of easing expected by June, this is already reflected in the current rates. He notes that the low end for mortgage rates in a stable economy might already have been reached, settling somewhere in the low 4% range. While higher than pre-pandemic levels, this rate is still considered manageable for those looking to enter the market. This level of interest rates, while not overly burdensome for borrowing, might not be enticing enough to stimulate a surge in housing investments, according to BMO. The arithmetic of investment and affordability remains challenging, potentially preventing an overheated housing recovery. For buyers and investors, this means that while borrowing costs remain relatively accessible, the market dynamics might still pose some challenges. In July, home sales in the Greater Toronto Area experienced a decline, following an unexpected increase in June that had interrupted a 4-month trend of decreasing transactions. The Toronto Regional Real Estate Board, TREB, reported a 1.7% drop in seasonally adjusted sales for July, compared to a 3.2% rise observed in June. Despite the decline in sales, the average price of homes saw a slight increase of 0.2%, reaching 1.13 million Canadian dollars, which is approximately $815,178.18 United States dollars. This marks the highest average price since December. However, new listings saw a slight decrease of 0.8%, according to TREB's release. Since the start of the year, home prices in Toronto have been on an upward trajectory, partly due to the gradual return of demand amid expectations of further interest rate cuts by the Bank of Canada. The central bank has already reduced its key policy rate twice in recent months, bringing it down to 4.5% from a high of 5%. Bank of Canada. Governor Tiff Macklem indicated that if inflation continues to ease, additional rate cuts could be on the horizon. The financial markets are currently anticipating another 25 basis point reduction in borrowing costs in September, with some expectations of a more substantial 50 basis point cut. This potential decrease in borrowing costs could encourage many prospective buyers who have been holding off to enter the housing market, according to TREB. TREB President Jennifer Pierce expressed optimism, stating, "The cost of borrowing is anticipated to decline further in the coming months. Expect sales to accelerate as buyers benefit from lower monthly mortgage payments." On a year-over-year basis, sales in July increased by 3.28%, with new listings rising by 18.47%. The increase in listings is attributed to homeowners who are facing significant increases in mortgage payments as their terms come up for renewal next year, prompting them to consider selling their properties. Toronto remains a key player in Canada's real estate market, accounting for approximately two-thirds of the country's condominium sales. As such, trends in Toronto often serve as indicators for other major metropolitan areas across the nation. Today, we're spotlighting an exciting development in the mortgage industry with Lendesk's Lender Spotlight 2024. As the year draws to a close, Lendesk is celebrating a series of significant enhancements to their platform, which have been game changers for mortgage professionals across Canada. These innovations are designed to help brokers work smarter and offer more value to their clients, making Lender Spotlight an indispensable tool in the industry. One of the major advancements in 2024 was the expansion of Lender Spotlight's alternative lending feature to include commercial lenders. This addition was highly anticipated by brokers who have been eager to support business clients with specialized financing solutions. Initially, the platform focused on residential and construction loans, but with this expansion, brokers can now confidently assist business clients as well. Christina Ria, Vice President of Marketing at Lendesk, noted that this was a natural evolution, responding to significant demand from brokers. The launch of commercial lending marked the largest traffic month to date for the alternative lending feature, demonstrating the need for such solutions in the market. Another groundbreaking tool introduced this year is the AI Assistant, which is revolutionizing how brokers handle complex mortgage queries. By analyzing over 7,000 mortgage policies, the AI Assistant provides instantaneous and accurate answers to intricate questions, allowing brokers to save time and offer more precise advice to their clients. This tool is a testament to Lendesk's commitment to equipping mortgage professionals with cutting-edge technology. The Scenarios feature, introduced earlier in the year, has quickly become a favorite among brokers. This tool allows brokers to engage clients with customized mortgage solutions by providing real-time affordability insights, comparing products side by side, and showing clients their financial futures through current versus proposed mortgage comparisons. These capabilities help build trust and simplify decision-making, enhancing client engagement at every stage. To cap off a year of innovation, Lendesk is offering a 30-day free trial of its Platinum features, allowing mortgage professionals to experience premium tools that streamline workflows and elevate client services. This includes access to a wider range of lenders, full lender guidelines, and the ability to generate polished rate comparisons for clients. By offering complimentary access to the AI Assistant and Scenarios tools during the trial, Lendesk ensures that brokers can explore the full potential of the platform without any barriers. Christina Ria highlighted that 2024 has been a defining year for both Lendesk and Lender Spotlight, noting the introduction of innovations like commercial lenders, the AI Assistant, and Scenarios as key developments that have empowered brokers to succeed. The free trial is an opportunity for mortgage professionals to elevate their client service and simplify their workflows, making it easier than ever to thrive in the competitive mortgage landscape. In a significant legal development, the British Columbia Supreme Court has certified a class action lawsuit against Airbnb, a popular short-term rental platform. This lawsuit alleges that Airbnb has breached provincial consumer protection laws by engaging in unlicensed real estate brokerage and travel agent services. The ruling was made by Justice Elizabeth MacDonald, and it centers on the claims of lead plaintiff Margot Ware. Ware's lawsuit asserts that Airbnb is operating without the necessary licenses to provide real estate or travel agent services in Canada. Moreover, it claims that Airbnb is not registered as a money services business with the federal government. Justice MacDonald's decision indicates that the lawsuit meets the criteria for a class action, representing consumers who have paid fees or commissions when booking through Airbnb. Interestingly, Airbnb and its related companies have argued that the lawsuit is an abusive process and a part of a series of repeated piecemeal attacks on their fee structure. However, MacDonald found that the only overlap with other legal actions was the recurring issue of alleged improper fee collection. The lawsuit impacts anyone who made a reservation with Airbnb for accommodations in British Columbia, excluding those located in the United States. It's worth noting that Airbnb has yet to respond to the lawsuit, which was initially filed in May 2022. Justice McDonald also rejected Airbnb's request to have the case heard in California, citing a lack of substantial evidence for such a move. This legal action could potentially expose Airbnb to damages under British Columbia's Business Practices and Consumer Protection Act, should the claims be proven. The case highlights ongoing tensions between digital platforms and regulatory frameworks, a matter that remains under close scrutiny by both industry observers and legal experts. As we continue to monitor this story, it serves as a reminder of the complexities involved in navigating consumer protection laws and the responsibilities of global companies operating in local markets. We'll keep a close watch on how this lawsuit progresses and its implications for the short-term rental industry. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.